Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, every time I hear that, I'm going, that's my show? Anyway, like the man said, Bill Bullington, here every Saturday morning, 11 to noon. And you can download this at 955 The Fish, 955 The Fish, their website. It's saved there as a podcast. You can also go to iTunes if you'd like to. And I believe it's on iHeartRadio as well. So lots of places to be able to pick this up. And you may want to do that this week in particular because a little bit later in the program, I'm going to hopefully enlighten, I'm going to shine some light on a particular topic, something that I see happening right now. And it's a very good opportunity, not only for the economy, but for investors. These things are kind of closely related, and I'm going to give you a little example of the kind of things that I typically do during a week when I'm looking and thinking at investments and thinking about them, trying to come up with ideas. I don't try to come up with the idea myself. I try to observe what's happening in the markets and try to deduce where I think there may be opportunities. And it's not as sophisticated as you might think. Actually, it's just a lot of reading and watching what's going on in the stock market. There are certain stocks that are moving right now. And you're going to have to wait until the last segment of today's show to hear about that. So we'll keep it, just stay tuned. And in the meantime, I do have a workshop coming up, and it's going to be, let's see, actually, I have to go look it up because I can't remember. While I'm looking it up, if you'd like to call us with a question, feel free. You can always call us right here at the station, 216-901-0945, 216-901-0945. And I'm not even hooked up to the internet yet. So 216-901-0945 is the number here. And actually, I'll probably have to wait until the first commercial break to hook up to the internet. So anyway, not going to have my charts right away. That'll be coming later in the show anyway. So there are some other things I wanted to talk about in addition to the seminar. Are some of the things that the government's doing right now to help a particular industry out. I think that's a kind of a big deal. But before I even get to that, at the last workshop, or last seminar, we were talking about retirement planning. And there were some people, I promised I would talk about it at least a little bit on each show because it is important. And you think about it, all financial planning should be heavily tilted towards retirement planning because one day, we're going to get too old to work. And how much retirement can you afford based on what you're doing? I think that's it's an eye-opener. And to do that, you really don't need a lot of information. All you really need to know are what your current savings are and what kind of my mind's going on me. What kind of income you'll have during retirement? What kind of sources of income? Social Security, pensions, that sort of thing. So that's basically it. Income and savings will kind of dictate what type of retirement you can afford. Now, I will add one other thing. The income and savings are all I typically need. Most people add a whole list of things to that, which I think are not necessary. But the one thing that is necessary is that we have some idea of how much risk you're willing to accept. And those three things are going to dictate what type of retirement you have. How much in savings do you have? What kind of sources of income do you have? And how much risk are you willing to accept? So that'll kind of dictate that. And the risk one is the only question that you can't really know the answer to until you sit down with somebody and start looking at various programs. It's very difficult to do, by the way. That part of it is extremely difficult. I find that a lot of people don't have any idea what kind of risk they're taking now. Look at their portfolios and they when we ask the questions as far as risk goes and trying to assess how much risk they're willing to accept. And then I look at what they're doing. Oftentimes there's a huge disconnect. And more often than not, they're taking more risk than they say they're comfortable with. So it's a perception thing, and it's something that if you don't do this every day for a living, I can see why it would be confusing. I can see how it would be confusing. It's really not all that difficult. We only use 7 questions, by the way, and it's from Morningstar. We use the Morningstar questionnaire. Gives us a pretty decent idea of what kind of risk you can take. Now, I add to that, I'll show you the portfolios that you would kind of qualify for under their methodology, and I'll show you what the risk in those portfolios are and what the returns have been. So anyway, not that difficult, but you do need to start with how much income am I going to have from Social Security and pensions, and how much in savings will I have? That's going to kind of dictate the lifestyle you have. So if you know those 2 things, then you're ahead of the curve. And it's great when you do this when you're in your 50s or in your 40s or 30s. The earlier you do it, the better off you are because you have more time to adjust. So if you're looking at something, you go, wow, that's really, I don't like that. It's not enough. Great. You've got time to adjust. The longer you wait, the harder it gets. So, but before I do all that, and I'll invite everybody today, you can call in and ask questions, 216-901-0945, 216-901-0945. And I'm going right to Jerry. Jerry, how you doing?
Good morning, Bill. I got a question. I'm not certain if you can answer it for me or if I need to give you more information or whatever, but I've had a whole life insurance policy for about the last 40 years of my life. Mm-hmm. It's accrued some significant cash value. At this point, I've been told by a friend that I have a cash value in it, or the cash benefit, excuse me, not the cash value, but the cash benefit is about $40,000. I could pull that out tax-free at this point, or I could keep it in the policy, and it would continue to accrue at about 6%. I'm wondering, from a standpoint of a person starting to consider retirement who doesn't need the money, would I be better to put it into maybe a Roth IRA or something, vehicle like that, do you think? Or
well, actually,
how does it generally work?
Well, there is no general way, actually, unfortunately.
Okay.
So you do have to look at that specifically because the contract that you have, that's a life insurance, it's a contract.
Correct.
Okay. They change them every year, and every insurance company, I think there are a couple thousand insurance companies in the United States that sell life insurance. Every single one of them has different contracts that they come up with each year in addition to the ones they've had in the past. So you're looking at, realistically, literally millions of potential options. And to find out what would be best for you, somebody's got to read through the contract that you have, looking at all the particulars. And they have to be extremely knowledgeable, by the way. A whole life insurance policy is one of the most complicated financial instruments on the planet. It makes options look like child's play.
Oh, Lord.
And so, yeah, I wish I had a really good answer for you. Unfortunately, that would take several hours.
Okay, well, let me ask you this. There's, I had a hard time understanding. I'm sure you would probably better comprehend it. The difference between a cash benefit and a death benefit. If I understand correctly, when you pass on, that you will get one or the other, but you won't get both. Is that's I've been assured is the case.
Well, most policies, especially if it's a policy that's as old as the one that you're talking about, they have a cash value. The cash value is part of the total death benefit. So let's say the death benefit's $100,000. And the cash surrender value right now is $80,000. They wouldn't get $180,000; they just get the $100,000 because the $80,000 is part of the insurance policy. It's the cash value, and now that's going to be split up. If it's a really old policy, it's going to have dividends that have accrued over the years, and it's going to have an actual cash value. And oftentimes, you can take the dividends out tax free. But
that's what I think they're saying. As I say, I can take about $40,000 out cash free, because that was in essence the premium that was put into it.
Well, this is what they did. They lobbied Congress to get that treated as a return of principal.
Oh, okay.
So basically, you can take the dividends out without paying taxes on it, because essentially you've already paid taxes on it when you made the premium payment.
Sure.
So, okay, so yeah, and that's true. And then a lot of those dividends paid up dividends or insurance policies in addition to that. So it's something that you really have to spend a lot of time looking at. And I don't know anybody, there isn't a single solitary millennial on the planet that knows how to analyze that, because those products have not existed since before they were born.
Okay.
So the chances of them actually spending any time with that at all are pretty much are very low. And even most of the people that used to deal in those products have either died or retired. Okay. That's a really old product, and I just happened to be. They used to do that when I first got in the business, like 30 years ago. That was still around, and it wasn't around for very long. By the way, it was only around for a couple of years, and then they took them away. And just out of curiosity, which company is it with?
It's Northwestern Mutual, which is supposedly a very good company.
It's one of the best for that particular product. They're in the top 1%.
Okay. Well, what I was told was that, and I asked my insurance guy, I said, okay, now playing devil's advocate, obviously he wants me to keep the money into it, or the $30,000.
Oh, he doesn't care. I promise you, he doesn't get that much on that.
Okay. Well, if I understand correctly, the insurance guys make their money from in the beginning, and then as the policy accrues, they get less and less.
Right.
If I'm not mistaken. Okay. But I said, now, what's the benefit of me? Or, why should I not take the money out and put it in another vehicle that I can do better than? And he said, well, what's the chances of you finding something you can do better than 6% guaranteed? And I said, well, I think I can, but you're right. There's no absolute guarantee in anything.
Right. Yeah, by the way, the guarantee is only as strong as the company making the guarantee. So if
they're pretty secure, though.
They have been, and I worked for a company that was bigger than they are, that had better guarantees than they did, and it ended up costing them so much money to try to make good on those promises that they had to sell. They strained their capital. They have net capital requirements just like a bank.
Okay.
And they're gone. That company's gone. So that's happened multiple times. You may have heard of one, AIG.
Oh, of course. Oh,
so what happens is when they go into bankruptcy, they end up dropping the benefits that they've already promised to people because they can't afford to pay it anymore.
They can do that?
Absolutely. They're not the government. See, here's the thing that people don't understand about the government. The government can make good on its promises because the government has this one special item that no one else has. It's called a printing press.
Yeah.
And they can make the problem go away, no sweat. And they're the only ones that own the printing press or the keys to it or are allowed to do that sort of thing. The other companies, they have to, they've got to come up with new business to be able to pay their obligations.
Of course.
And when they feel like they can't, those obligations, yeah. So.
Wow. Okay. Well, thank you, Bill. It's very informative as always.
All right. Well, hey, thanks for calling. Have a good weekend.
You too. Bye.
Bye. And hopefully I get my email. Not my email. My website connection set up here during the because I know we have a seminar coming up, and I can't I can't pull up the date. I never bother to memorize that stuff. By the way, I read once where Albert Einstein, and not that I'm an Einstein, believe me, but he wouldn't memorize anything that he could look up easily. And I kind of get that, that's why would you waste that mental energy looking up an insignificant thing that you can just go look up? So you write it down and you forget about it until you need it. Then you hopefully you remember where you wrote it down. And it'd be hard for me to forget my website address. So it's on there. And we're going to be talking about socially responsible investing, by the way, which is kind of a big deal. And I was amazed. So I have this really super cool database because there are only about 60,000 funds now. That's it. That you have to weed through and try to find the good ones. And so I have this tool that helps me do that. and it has a setting on there that looks for socially responsible investing. And I'm amazed at how well a lot of these funds have done. When they first came out, they didn't do that well. When they first came out, the performance, you suffered to be able to invest in socially responsible funds. And those are funds that don't invest in things that some board decided were not up to par, like animal testing and a whole bunch of other stuff. Some of them, they don't invest in casinos and that kind of thing. So I was amazed that, at first I wasn't amazed. I kind of thought, well, I don't know. I don't know how well that'll do. And a lot of the newer funds didn't do that well. But they've gotten better, and I'm really surprised. So, who'd have thought? You can invest socially responsible and be very profitable. So we're going to be talking about some of those funds and how you work that. And we always talk about, there are other things that we're always talking about. I'm going to go over that retirement plan again, the 10-minute retirement plan. Essentially, the two things you need to know if you wanted to call in to talk about it. You can go to my website, bullingtoncapital.com. You can sign up or actually just email us. I'll be glad to talk with you over the phone or in person. You only need to know how much in savings you have and what kind of sources of income you have. And then I've got this 7 question, not 7 pages, 1 page. 7 questions on 1 page questionnaire. And pretty much I can even sum that up in 30 seconds. Just imagine looking at your portfolio and start subtracting percentages from it to try to get an idea of how much your risk tolerance really is. And that's it. That's all you need. You get those 3 questions answered. By the way, that last question is tricky, especially if you're married, because married couples tend to have 2 different sets of ideas when it comes to risk. A lot of people differ that way. That's fine. But if you're going to do it that way, then we just have to come up with some sort of negotiation. And now that I hear the music, that means I'm going to have to negotiate this commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
It's my favorite thing.
All right. Hey, I think you want to probably try and pay attention a little bit later in today's show. Yeah, because we're going to be talking about some opportunities that I've seen in the market. And this is basically how this goes. Okay? So I have this program that scans through all the investable stocks. What are those? Those are stocks that a mutual fund can invest in, or an ETF. That's exchange traded fund for you new guys. Yeah, so if a fund can invest in it, I want to know about it. Why? Because the funds have, I don't know, trillions, 10s, 15, 20, I think it's actually closer to $40 trillion invested in them. And if they're buying the stocks, those stocks have a tendency to keep going higher until one day they don't. But at some point in time, you get a stock that's going up and the stock is underpriced. And that's a good thing. That increases the odds of you being able to invest profitably in those companies. We're going to be talking about that at the workshop that's coming up, and I did get the website up here, so I'll pull it up really quickly. Yeah, it's a Thursday night, November 2nd. We're going to start at 6:30. The major theme is socially responsible investing. I'm only going to spend about 15 to 20 minutes on that because I've printed out a lot of the material that these mutual fund companies put out for the socially responsible. And there are a couple of ETFs that do that too, by the way. And I'm just flabbergasted that the returns have improved so much. When they first started in that particular area of the market, they didn't do very well. A lot of the funds didn't do well at all. And that's changed. A lot of them are doing incredibly well. So that's Thursday, November 2nd. And by the way, I have 2 of my own personal Cavs tickets. It's a game that I can't attend. So I'm just going to do a little drawing at the seminar too. These are my tickets, and they're pretty good. They're in the VIP, so there's free food, free parking, and I'm going to give 2 of those tickets away at that seminar. So the seminar is Thursday, November 2nd, 2017. You can go to my website, bullingtoncapital.com, to sign up online. There's no cost to attend. The seating we actually limit it to 100 people. It holds 120, but we limit it to 100 people. So we're not all sitting on top of one another. Anyway, And a little bit later in today's show, we're going to talk about some of those themes. How do you identify that kind of thing? And it's pretty cool. I'm pretty sure that this is a real one. I mean, when I say real, but a lot of industries, a lot of companies will give you a lot of false starts. They'll actually start going up really fast and draw a lot of attention, and then all of a sudden, bam! The sucker goes right down. Hate when that happens. Actually, I don't really care anymore. That's one of the other things that we'll talk about is how do you protect yourself? How do you reduce your risk? Even with a socially responsible fund, those are still investing in stocks. And stocks are volatile. They are all volatile. There aren't any, saying this is a safe stock is like saying, yeah, I got a 10-pound jumbo shrimp. I'd like to see that. I know I've seen jumbo shrimp. They're not 10 pounds. But anyway, so I digress. We'll be talking about that at the workshop. I'm going to give you a couple of Cavs tickets away at the workshop. So you can go to BullingtonCapital.com to sign up online. We talked a little bit earlier today about the 10-minute retirement plan. We're going to touch on that all the time. It's an important thing. It's a really important thing. I'm always mesmerized by how people don't really know much of this. They don't have much information on retirement planning. And I keep hearing this, well, they should teach kids how to balance a checkbook in high school. Really? Who's going to balance a checkbook today? Why should they teach that? It's like teaching somebody to drive a Model A Ford because it is a car, but it's not going to help you very much today. So they should really teach them how much money it requires to be able to retire and maintain your lifestyle. That's a big one. Okay, and they don't. That's not being taught. And if they did, the savings rate would probably increase, probably 150 to 200% in the United States alone. If they started talking about that when kids are right around 12, see, because if you get them when they're 12, before their hormones kick in, they'll still listen. When you get them and the hormones have kicked in a little bit later, and you can't talk to them until they're in their late 30s, if then. So you need to get them young because it's kind of a big deal, and it's really hard. And I see this all the time. I got to help my kids. We've got to send them to the best private schools, and I've got my daughter's having a wedding. Great. So you're going to pay for that, but how do you know how much you should be putting away for that retirement? So because if you're not putting enough money away for retirement, it's nice that you want to take care of your kids. And by the way, I've overspent on my kids, so don't worry about it too much. But I also knew that I was going to have to make that up one day, and which is basically what I'm doing now. Putting a lot more money away because one of these days I'm going to be too old to work. That's a long way for me right now, but if you don't get started early, then it's a problem. If you let it go too long, it's a big problem. And you got to have some idea of what that number is. And when you start looking at it, and let me just give you a little math here to help you out. Say you want to have $50,000 of income from your investments, okay? Income from your investments to go with whatever Social Security and pension you have, $50,000. If you're going to pull out 5% a year, notice I didn't say earn 5%. I said if you're going to pull out 5% a year. We'll come back to that in a little bit. If you're going to pull out 5% a year, which means if you earned a 0 rate of return on your investments, you'd run out of money in 20 years. Okay, so if you're 65 and your life expectancy is right around 20 years, at 65. Actually, I think it's about 22, 23. But if you earn nothing, in 20 years, you'd be out of money, pulling out 5% a year. So that's our bogey. Whatever you want to take out on an annual basis, you multiply that by 20. And by the way, you're going to have to invest, today especially, with interest rates as low as they are, probably going up. When interest rates go up, bond prices tend to go down, which is flooring me because in this morning's Wall Street Journal, they said the TLT, which is long-term treasury exchange-traded fund, has had one of the biggest accumulation periods in its history. People are buying it now. That is trouble. That's big trouble. There's no way. That makes a lot of it. In fact, they'll be lucky over the next 10 years if that doesn't lose a significant amount of money. So I'm looking at it, it peaked. The peak, the all-time high in that is $143 a share. Remember, it's a fund that invests in government bonds. 143. It's at 126 now. And by the way, that was over a year ago. So after over a year, you're down about 20%. The 3% income you got from that is not enough to set off the 20% drop. And I'm here to tell you that is not over. And if you look at year to date, it's actually done very well from January to now. That's why you can't look at short time periods like that. They're meaningless. Absolutely meaningless. And it's one of the reasons people have been buying it. I promise you. They just don't know any better. And that's one of the reasons I have a radio show. Because they don't know any better. Somebody needs to tell them. Somebody needs to wake them up. Say, don't do that. I don't care what it's done this year. You got to live for the rest of your life. And stocks will do that. Bonds will do that. They move opposite of the direction that they should be moving. And sometimes for several years. And you have to know that so that you can ignore it. You've got to know what you can know. You've got to know what you can't possibly know. And the hardest part is you got to know the difference. That's the one where people struggle. They want to know things that you can't possibly know the answers to. Like I don't have to know what the market's going to do over the next year or two. And what it's done over the past 12 or 18 months or even the past 2 or 3 years is insignificant. In the grand scheme of things, it's insignificant. Doesn't matter. What matters is what you're doing with the money. And eventually, if you're doing the right things, it's going to pay off. So that's the same thing with retirement planning. You've got to do the right things. Eventually, if you're doing the right things, it's going to pay off. You'll be able to reach your goals. Will you be able to get rich quick? Probably not. To get rich quick, you have to take an awful lot of risk. And who wants to risk your retirement money on a get rich quick scheme? I don't know. Some people do. I see it all the time. And normally they come to me after it's not worked out and say, can you fix this? And I'm like, well, probably not. Because as fast as you lost the money, to make that money back doing the right things, it's going to take probably 5, 6, 7, 8, 9 times the amount of time it took to lose it. And that's precarious. So, and realistically, it's not that hard. I mean, there's the basics are pretty simple. What did we just talk about for the retirement plan? What do you need to know? You need to know what your sources of income are and what your savings are. That'll give you an idea of how much you can expect to take out. I use the 4 to 6% rule. That's kind of a band. You get beyond 6%, and quite frankly, I'm not allowed to advise those accounts because I'm an accredited investment fiduciary. And that's not safe or prudent. Okay, so if it's not safe or prudent, if it's not in your best interest, I'm not allowed to do it. But I can tell you that too. And I know people, and I encourage everybody to have some money that they manage themselves. That's why at the workshop that we'll do, I'll talk about identifying these things, like the area that we're going to talk about the last segment of today's program. And I know that's probably killing people. Especially if you're driving somewhere and you have to get out of the car, don't worry about it. You can go to my website and download it and listen to it there. And at some point in time, I'm probably going to get these broken up into 3 mini pieces because we do, I think 15 minutes, and then we take a break and another 15 minutes. So I'll probably just put all 3 of them up separately and listen to them whenever you want. Personally, I can't stand the sound of my own voice, so I wouldn't listen to it at all. I would never listen, but I'll tell you the information we're going to give out today. I think it's good. I think it's really good. I think it's really fascinating that John McCain decides to defect, and also Rand Paul, and it looks like they're not going to get much done on that health care bill. And good, bad, or indifferent doesn't matter. But why on the same day that the bill gets passed, Molina Healthcare has a daily range of about 6%. You think that's coincidence? And that's what I'm talking about. I'm not recommending the company. In fact, let me see. It was up. Yeah. Oh, it was up. I can't. Yeah. Wow. That's a big range. Holy cow. One day. That was a 6% 1 day range. Okay. That's pretty big. Now that stock jumps all over all stocks are extremely volatile, which is another thing I wanted to point out today. Whenever you're reading Barron's or the Wall Street Journal or Yahoo Finance or whatever you read, and they say this stock could go up 20% this year, you know what? You are telling me nothing. That's like saying the Browns are going to play again someday. That's exactly what it's like. Every stock goes up or down 20% a year. Actually, they go up closer to 50% a year if you measure from the top to the bottom. That's the average range of the average stock on the New York Stock Exchange. Telling me it's got the chance to go up 20% is telling me nothing. That's like telling me it's going to be colder in December than it is in August. Thanks for the help. I really needed that. It just drives me crazy when they put that out. I don't know why it drives me crazy. It's just oh, you know, I do remember why it drives me crazy, because I used to get people calling, hey, they said this might go up 20% next year. Yeah, and the sun may come up tomorrow, you know. So what's the difference? You really want stuff that's moving up for a reason, and sometimes the stocks move before the reasons are apparent. That's why I like to look at companies that are moving right now. And incidentally, if you don't want to do this, if this is too much work, and I understand, only do it with a small amount. I think everybody should manage at least a small amount of their money. And I feel pretty strongly about that. Why? Because it's pretty important. You get to see what it's really like. It'll give you empathy and compassion and understanding for what the portfolio managers are going through that are out there, doing this every day for a living. It can be a drag, because it's pretty tough in a lot of cases. Anyway, I keep forgetting to give the phone number out. If you'd like to call in today, it's 216-901-0945, 216-901-0945. Going right to Tony. Tony, on the Bullington Capital Report.
Good morning, Bill.
How are you?
I'm fine. I want to first thank you for your shows. I've learned a lot, saved my butt a couple times.
Oh, thanks.
I've been talking with some people, just get some ideas. When do you convert your 401k stuff over to a Roth when you're getting near retirement? I know some people say if the taxes we're paying are real high, or the tax rate's low, there's one way or the other, and I'm just kind of confused.
Yeah, you're confused because that's one of those things where you can't really know what the answer is going to be, and you have to make a decision anyway. Because I know it's really rough. I'm going through the same thing. In fact, it looks like some of the proposals that I've seen, I've got this government function on this Bloomberg terminal that I pay an exorbitant amount of money for. I'm embarrassed to say, but every time a bill comes up, I can read it right there. And some of the proposals for the cuts in taxes are fairly significant. So and here's a risk: if I go ahead and convert this year, and then they don't, and they make the cuts, but they don't make them retroactive, which has got a relatively high chance of happening. Then I'm going to miss out. I may have to recharacterize that Roth into a regular IRA and then try to do it again. So if they allow you to do that, they don't have to allow you to do that. So everything has some element of risk to it, and especially when it's one of those answers that you just can't know ahead of time unless you have a crystal ball that works. And if you come into my office, I'll show you my crystal ball. It doesn't work.
Oh, okay.
I have a real one, and it doesn't work. Hey, Tony, did you want to hang around for a minute? I got to take a real quick commercial break.
I'll wait. Thank you.
Okay, thanks. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. I'll be right back. And we're back. Hey, Tony, you still there?
Yes, I'm still here.
Okay. I forgot what we were talking about.
We were talking. I'm looking. I'm a couple years away from 65.
Okay.
And I'm, what to do with my 401ks, and there's a lot of information about converting to Roth.
Right.
But the other thing too was, I've been told that if you retire, then that year you're going to have a lower income because you're not working anymore, and that may be the time to do some converting also to save on taxes.
Yeah, it might be. I wouldn't put taxes at first. I would kind of wait to see what the tax, because they haven't talked about raising taxes at all.
Okay.
And right now they're talking about cutting taxes.
All right.
So if you ended up in the past, whenever somebody has converted, and I forget what the time period is, but if somebody's converted, paid the taxes, at some point in time they were able to or unconvert and then convert it again. I don't know that they'll always allow the people to do that. So
Okay.
I think the safer thing is to wait to see whether or not some of these things go through.
Okay.
But then you kind of have to balance that out too. If you make a lot less money in the year that you retire, and then the next year, for whatever reason, you have some sort of a windfall, you took a consulting job and then made a whole lot of money again, and tried to convert it that year, then you'd be paying higher taxes. So there's so many things, and what ends up happening is you have to figure out what you think is the most likely scenario, and then just take it from there. And it's going to be a guesstimate.
All right.
There's no way to get that perfectly.
It may be take a part of it, not all of it, to see where you end up.
That's a good idea. At least you're half right.
Okay. All right.
Hedge your guess. And
I was
yeah.
thinking about coming to your seminar. Besides the socially responsible stuff, what are a few other topics you may be touching on?
Well, one of them I'm going to talk about is we've got my clients. I'm working on this thing to put out just a network that you have to understand what I'm doing with it to be able to use it, because I'm a big believer that everybody should have at least a small account that they manage themselves, and there are different ways of doing that. I just think it's a good thing to do. It gives you an appreciation for the whole money management business. And whether people know it or not, they all have their own businesses. When you have an investment account, you're managing that, whether you think you are or not. You're the one that's your name is on the account. That's your account. Now, you may have hired other people to come in and help you with that and do that, which is what a lot of good CEOs do. But that's still your own little micro business, and you're going to be directly benefited by the result of whatever happens there, or in the case you might suffer the circumstances, depending on how well it's been managed. So I think it's just important. So I'm going to be talking about something I'm going to be talking about in the next few minutes. There are several companies that are involved in one way or another in solar. Okay, in the solar. One of them's Canadian Solar. They make semiconductors that are involved in the conversion of solar. They're part of a solar panel. Other one is First Solar. That's a company that it's come up on scans, been coming up on scans for several months, and I already own that one. There are several other solar-related stocks that have been coming up on these scans, and the reason I know that is because I look at them every day. And I typically spend a fairly decent amount of time, not as much as I used to because I don't have to anymore because I've gotten better at it. But the bottom line is I'm watching this stuff every day. I start to see these trends start to form because stocks that are in similar businesses are moving at the same time, and the volume and the shares traded and the percentage up that the stocks are moving in is above average. Okay. And then this morning, I'm looking at the Wall Street Journal, and there's a little tiny, it's like 1 inch by 1 inch. There's a mention that a government board cleared the way, actually one of the Trump administration cleared the way to use what they referred to as a legal weapon to restrict solar panels coming from China. So, coincidence?
Oh boy,
I don't know. I don't know. But those little clues, like,
right.
Hey, why are these solar stocks running? And by the way, their valuations are extremely low. So, like, if you're in a neighborhood where all the houses were selling for, $250,000, and maybe they're all a couple thousand square feet, so that's a little over $100,000 or a little over $100 per square foot, and then one comes in that's only $50 a square foot. The first thing you want to know is what's wrong.
Of course.
Do they have radon? But and assume you checked it out, and no, it's actually somebody, unfortunately, or fortunately, got a great job in California. They moved over there, and they don't care what they get for the house because they got this big pay raise. That happens very rarely, by the way. But if it does happen, you'd like to be able to recognize that. And the first clue is that the house was maybe it was selling for 30 or 40% lower than the other houses in the neighborhood, which makes all the neighbors mad, by the way.
Well, when Obama took over and started spouting about solar, I dove in solar really heavy, and then
And it hurt you, yeah.
lost pretty bad.
Yeah, that's the thing. They're stocks.
Right.
All stocks fluctuate a lot, especially stocks that are in a new industry.
Right.
You'll see them fly, and this is why you really can't take your eye completely off of them. You got to have some sort of a selling mechanism in place. And with this particular style of investing, because there are multiple styles of investing, but with this particular style, you set a sell stop order. I'm going to recommend Fidelity for this, by the way, because of the way they execute their trades, and I'll explain that in detail at the workshop because it makes a difference. And so I'm going to recommend them. They'll probably get mad at me for using their name without getting their permission, but oh well.
Send them some business, right?
Yeah, I mean they actually are above. They're the best clearing firm, I think. That's my personal opinion. And I use Interactive Brokers, and I've used every custodian at one point in time or another, and I just like them. So anyway, but First Solar is one of the stocks that I already own. I have to tell you that because I own it. And it came up on the scans. When the stock is going down, you don't want to be around if you have the ability to manage it yourself. And it's one of the reasons that funds are so popular, because you don't really have to manage it. There's a manager in there that's doing that sort of thing for you.
Right.
So I'm going to talk about that because for me, it's always been fun. It's not as difficult as people think it is intellectually. Intellectually, it's super simple. In fact,
it keeps you on your toes, but you gotta keep at it. You can't go like a week without looking at stuff.
Well, you can. You could actually just go on Saturdays, and what you do is you'd use the weekly closing prices, and I think you would actually do better doing that.
Think so? Then daily?
Yep.
Looking at it?
I'm pretty sure you would.
Okay, I'll give it a shot.
Yeah, and it's all psychological, by the way. It has nothing to do with intellectual or watching data. You're going to have stop orders in on this particular style. You will have stop orders. Now, people get confused by this all the time. This is trend following. We're just following trends. That's it. And how do you know when to get out? When the trend is, when the trend reverses, that's when you got to get out. How do you define that? I'm just going to give you a really simple definition that was invented by a guy who was a code breaker in World War II, and it still works all these years later. I'm pretty sure it works because nobody remembers that guy anymore, and they don't know how simple it is and what the concepts are. So we're going to talk about that for at least 15, 20 minutes because it's just not that hard. I could teach somebody how to do this in an hour. I can't give them the courage to stick with it. That's
right.
like I can teach you how to lose weight really quickly too, but I can't. I can't be there at your dinner table saying, "Hey, you shouldn't eat that."
What your intake is,
Yeah, and it's the same thing. It's relatively simple, but it's not easy. Diet.
Right.
Dieting is simple. It ain't easy. I struggle with that my entire life. So.
Yeah, well, you just got to stop eating after dinner or no more snacks. It's
Well, for me, it's just stay away from carbs. Processed carbohydrates. That's what works best for me.
You got to watch out for these carbohydrate stocks, unless you're risky.
Yeah, yeah, absolutely.
Hey, thanks, Bill, and
Hey.
I'm going to sign up.
All right, thanks for calling, and I'll see you at the seminar.
All right, bye.
Yep, bye-bye. And anybody else can sign up. It's Bullington Capital. Like I said, we're going to be talking about socially responsible investing. I'll have a couple handouts this time, and everybody's always asking for handouts, and I'll have handouts on a couple of the funds that I like that I'm going to be using. By the way, I did all this this was a request of a client. I really never paid attention to socially responsible investing because the first few years that it gained any popularity, those funds weren't doing very well. I mean, it was at the expense of returns. And I'm like, wow, I don't know if I can do that because I know people want performance in addition to that. And today that's changed, and I probably would not have revisited that had it not been for a request of a client. So that's why I always encourage you to send questions. It's one of the reasons I've gotten to know as much as I have about this industry is because I've had a lot of clients that were asking questions and had to go look up the answers. I didn't have to. I just wanted to. But so it's kind of neat. And I guess I owe a lot of my education in this business to listeners asking questions. And eventually you get to know quite a bit. And you get to know what's important. And more importantly, you do learn that lesson I was talking about. You need to know what you can know. You need to know what you can't possibly know. And you got to know the difference. That is not always that easy. Not always, especially when you're new. When you're new, it's pretty tough. And I got, is that 30 seconds? Okay, so we got about 30 seconds. So my name is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can also pick this up, 955 The Fish, the podcast. It's available there. You can go to my website and download it. You can go to iTunes and download it if you heard something you wanted more information on. You can also contact me on my website through the Contact Us page, and I will be sure to follow back up with you. And have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.